In figure 32.10, we're interested in bullish advisors as a percentage of those with an opinion. This presents a longer term picture of how advisors are feeling. So you can say that whenever there are many bulls, then you can say that it is once again, let me just quickly again remove all this, whatever I have underlined. Okay, okay. So where were we? We were here. The presence of too many bulls indicates a market top, while too few bulls show a market bottom. Okay. Again, the trick is to discovering how many are too many or too few. There are three brackets in two analysis on the chart, adding a bit of complexity to the straightforward. Okay, so I'll tell you something quickly. This is how the indicator looks like. Okay, so we have three brackets. The first one is an above bracket. Then we have the bottom bracket, and then we have the middle bracket. Okay, so whenever the price, listen to it carefully. Whenever the price crosses the upper one, you get a buy signal. Whenever the price crosses below the below bracket and then goes up again from here, that is also a buy signal. And the third case of getting a buy signal is when the price is anyway trending up and then it comes down, it goes below the middle bracket. Without going below the bottom bracket, it again goes up the middle bracket. That is the third buy signal. So these are the three buy signals which you need to keep in mind, and the opposite will obviously be a sell signal. Whenever a market, whenever the price is above, and then one sec, whenever the price is above the above bracket and then it crosses down, it is a sell signal. Whenever the price is coming down and crosses the bottom bracket, again it is a sell signal. So these are the signals which you need to keep in mind. And it, what does it say? Whenever the market crosses this and then crosses back down, it shows that a market extreme has been formed or a market top has been formed, and now the price will reverse. And when the price crosses this and goes up again, that shows that a market bottom or a market extreme has been created, which means that the price will go up from here. So that is how you basically get a buy signal or a sell signal. If you want, you can pause and you can read this. That's what I've explained. All right. Okay. Now let's come to the mode. Okay, the mode basically has brackets of 53 and 69. This indicates that the market does well when the reading is below 53. So the market is doing good whenever the reading is below 53, and whenever the reading is above 69, the market does not perform well. However, you need to keep in mind that half of the time this indicator is neutral. So you can pause it and you can see this as well. And moving on, we have a very important indicator, which is the PE ratio indicator. So PE is basically the price to earnings ratio. Okay, price to earnings. The numerator P is price and the denominator E is earnings. And in this case, we are going to take the earnings on the basis of median earnings yield. Okay, so why are we doing that? Why do we invert the median yield? And why are we even taking median in the first place? Why can't we straight away take the direct earnings? We are doing that so that we can account for volatility, right? Because so that not one big or questionable earnings should not be having a advantage or a very significant impact on the price or on the ratio. Due to that reason only, we are always taking the median. So you need to keep that in mind. And one more thing you need to know is that when the PE ratio goes beyond a factor of 24 or one standard deviation, we're getting into optimism as it breaches the next bracket up. So whenever it goes which is it goes beyond a factor of 24 or for a standard deviation, so either it should be above a factor of 24 or one standard deviation. It's the same thing, right? So in that case, you can do a buying. So one thing you need to know is that whenever the PE ratio is about 22.5, that means that it is overvalued. And whenever the price is below 14.5, that means it is undervalued. And if we talk about the integrate indicators contribution to the Fab 5 model, you can see that whenever the price is below, whenever the PE ratio is below 14.5, that means that it is undervalued. In that case, we give it a score of +1. Whenever the PE ratio is between 14.5 and 22.5, that means it is in the range, which means that it has no contribution in the Fab 5 model, and you give it a score of 0. And whenever it is 22.5, which means it is overvalued, you are going to give -1. So you need to keep that in mind. Okay, so and one more thing, you need to keep in mind that whenever the interest rates are low, you can assume that the particular indicator is more bullish. So this is the indicated relative interest rate, which interest rate component, which is a composite, and it is calculated on either 91-day T-bills, 10 treasury notes, or Moody BAA corporates. So this basically talks about how the interest rates also play an important role in the stocks. So whenever the interest rates are low, you can assume that the indicator is going to be bullish, and whenever the interest rates are high, you know that the indicator is basically bearish. To find extremes, we use 60-week moving standard deviation with a plus or minus of 1.3 standard deviation. So whenever it is below the bottom bracket, then it is -1. Whenever it is in between the brackets, you give it a score of 0, and whenever it is above the upper bracket, you give it a score of +1. All right. Moving on, we come to another indicator, and it is called as trin. And it is also, we have also studied this in an earlier chapter. It is also called as MKDS or the MKDS or the trading index. So this is a trin indicator. So this is basically based on the market breadth, and by market breadth, you know what I mean. I'm talking about the advances and declines. So you are going to basically take the ratio. Okay, first let's see that. You're going to take the upside volume, downside volume, and then you're going to see if it's concentrated in advancing or declining issues. So how do you calculate the trend ratio? It is calculated by dividing the ratio of advancing issues to declining issues by the ratio of advancing volume divided by the declining volume. Trend's normal 10-day moving average is calculated by adding up individual day readings and dividing the result by 10. In contrast, the Open 10 Trading Index uses the 10-day totals of each trend component, up stocks, down stocks, up volume and down volume, rather than using individual daily computations. Once these total are determined for 10 days, they are inserted in the usual trend formula. So that is the trend formula which we anyway did. Okay. Contribution to the sentiment component is -1 when both trends are negative, or one is negative and other is neutral. So -1 is when both the trends are negative, or one is negative and the other one is neutral, and 0 when they sum to 0. So when you sum them, if you get 0, in that case, then you are going to give it a 0. And when both are positive, or when one of them is positive and the other one is neutral, then also you give it a score of 1. So you really need to understand these indicators which we've been studying, and you need to know that what score does it take in the Fab 5 model. And while it might seem difficult right now, you need to uh, watch the video again, and you need to also mm, write it down so that you can understand it better. Back in the 1980s, Net conducted weekly research meetings. He was a huge value line fan. He loved the firm's approach to research and loved its indicators. One day he had told a story about Arnold Bernhard, the founder of Value Line, who had built a hugely successful investment research firm that ultimately stood on its own feet independent of him. When Arnold Bernhard died in 1987, his death was widely reported but had no effect on the company. It was business as usual, and Value Line is still very strong and well respected. Ned's point was that he hoped Ned Davis Research, the firm he founded, will someday have the same foundation. Okay, so what is Value Line? In case you don't know what Value Line is, you can look it up on the net. So Value Line is a very famous indicator, and it was originally a firm, and it is still date being used. And in fact, I can even show you that there's still a website on Value Line. Let me show that. Yeah, see, there's still the website for Value Line, so you can use it. It is very useful, and it gives you a lot of knowledge. We can even look at the Value Line indicator if you want. Yeah, so the indicator is shown in the bottom of 32.15. So this is how the value line indicator looks like. uh, is one of the value line's key fundamental indicators, and it is based on its analyst 3 to 5 year PE projections for the stocks in in their universe. The estimate of the median price appreciation potential found by multiplying each stock's current earnings by its future PE projection as determined by value line analysis. Each stock gets a value, and the median of these values is VLMAT. As value line points out, though, the VLMAP tends to be a bit high. We have applied the NDR moving standard deviation reverse bracket solution to this indicator. The standard deviation is 9 months and the brackets are asymmetric to -1 to 0.6. Although it can't be seen on chart, we allow the signal to go neutral. The contribution to the Fab5 sentiment is +1 when the 6 week smoothing of VLMAP drops below the upper bracket. So whenever it drops below the upper bracket, you give it a um one second. Yeah, you give it a +1, and whenever it moves from below to above the lower bracket, you give it a -1. The sell signal looked bad. Okay, so that is what it is. So whenever it goes from above to below, you give it a +1, and whenever it goes from below to above, you get a -1. That's it about the value line indicator. Okay. Although the daily trading sentiment composite given in 32.16 is just an indicator to the Fab 5, in reality, this is a model composed of 27 individual indicators from 6 areas. Advisory service sentiment is based on results from various polls, including those from National Association, etc. So, what is advisory service sentiment? Whatever the sentiment is according to various sorts of advisories. And then we have asset flows. Asset flows basically has 13.3%. The biggest contribution or the biggest percentage is by the advisory service sentiment. So asset flows basically looks at the commitment of traders reports and the mutual fund flows. So you still know that you can check out the commitment of traders reports. And then we have the overbought and oversold. Then you have valuation or sentiment, and then you have volatility. Volatility is based on the VIX index. I don't have to go and describe what VIX is. VIX basically talks about the um, volatility or the kind of fear which is there in the market. And then we have put call option ratios, and this also we saw in the options chapter. Each of the 27 indicators uses moving standard deviation brackets. During testing, each indicator had to work in all four predetermined time frames before being selected for inclusion. For an indicator to make the final model, there had to be plenty of good results to pick from. This is true for any indicator in any Net Davis research model. If you have a feeling that an indicator has a strong relationship to the market and you're using the appropriate techniques. All right. If an analysis turns up only a small percentage of decent results, one second. Yeah, decent results. The indicator isn't any good, the analytical technique needs refinement. If there are only a handful of acceptable results after exhausting all possibilities for analysis, chalk those results up to luck, toss the indicator, and move on. In case of the daily trading sentiment composite, virtually all of the indicators had plenty of acceptable results. The composite itself is basically an inverted diffusion index, inverted so that high numbers are excessively optimistic and therefore bearish, and low numbers are pessimistic and therefore bullish. The three charts that follow illustrate several components. The first is Hulbert newsletter. Okay, so 32.17, we have the Hulbert newsletter, talks about the stock sentiment which is there in the market. The composite itself, Hulbert measures average equity exposure among a subset of advisors who focus on timing the overall stock market's short term gyrations. This is a type of daily trading sentiment composite indicator showing the moving standard deviation brackets in the middle clip, with the bottom clip reflecting the same thing but in a form called the Z score. Doing this allows us to compare one Z score with another without The fog of periods in brackets when most of the advisors move to the bullish side, that's negative to the market, and vice versa. Okay, the classic overbought and oversold indicator, which is shown in figure, okay, this one in the figure 32.18, is based on extreme volume movements. We have taken the NDR multi-cap universe and presented advancing volume as a percentage of advancing and declining volume combined. When advancing volume reaches an extreme by violating the upper bracket of the standard deviation window, it's typically negative for the market. Volatility is sentiment in motion. Figure shows the VIX to be bearish during the low volatility periods and bullish during high volatility periods. The reversals when most of the gains are made. You know the VIX index, right? Okay. The contribution to the Fab 5 sentiment component is plus 2 when the daily sentiment composite is below or above the is below when the daily sentiment composite is below the lower bracket, and 0 between the brackets, and minus 2 above the upper bracket. So whenever the daily sentiment composite is um, below the lower bracket, you give it a plus 2. Whenever it is above the upper bracket, then you give it a minus 2, and whenever it's been between the brackets, you give it a 0. Talking about sentiment summary, the final sentiment component shown in figure 32.2 is the sum of the indicators discussed, plus one more, which is the PE indicator, for a range of minus 8 to plus 8. Remember, the daily sentiment composite has double weight. The brackets are at minus 1.5 and plus 1.5. The monetary component. Our third major piece in the Fab is the Fab 5 monetary component. The adage, money moves markets, is probably as old as the markets themselves. Without demand in some form of purchasing power, there would be no markets. The availability of money equates to liquidity, and measures of liquidity help us to handle on risk. Of course, the source and quality of money also matter, and our view of the monetary situation comes from two major sources: the price of the money, meaning interest rates, and the supply of the money. Rate of change in interest rates, regardless of what maturities we're looking at or whether we are examining government or corporate securities, yield consistently good results against the stock market. My real look at this was in 1987 when Ned came up with the idea of bulls plus bears, in the context of the monetary environment. He thought that when a bull market was underway, it would make a much higher percentage of bulls to send the bearish signal than it would in a bear market. He hypothesized the same should be true for buying the market under favorable conditions. The percentage of bulls shouldn't have to drop as far as it would have to under bear market conditions. To test this, we use a 26-week rate of change in intermediate government bond prices as proxy. Bond momentum above a certain level would indicate a bull market, while momentum below a lower level would indicate a bear market. I can remember Ned standing behind me tossing out ideas while I sat at my desk doing my best to program it. The indicator shown presents Moody Corporate BAA yield 32.21. So, this is the Moody BAA bond yield. You can look at it in the chart. So, what does it say? When interest rates are heating up, it's bad for stocks. When interest rates are going down, it's good for stocks. The brackets set for the NDR multi-cap geometric total return index, but they work well for the S&P 500. The contribution of the Moody corporate BAA yields is plus 1 below below minus 3%, 0 between minus 3 and 6%, and minus 1 above 6%. So whenever the interest rate is above 6%, you know it's bad for stocks, so you give it a minus 1. Whenever it is below minus 3 below minus 3%, then you give it a plus 1, and if it's in the middle, then you give it a 0. Figure shows the annual growth of the industrial production and commodity price movement to the PPI, producer price index, subtracted from 12-month change of the M2 money supply, illustrates the relationship between the M2. Okay. Liquidity represented by current dollar M2 money supply, a measure of the money available in spending. When M2's rate of growth exceeds that of industrial production and PPI commodities, there is excess liquidity in the system, some of which flows into stocks. The periods of excess liquidity is shown on the chart. So you can look at the chart. When economic growth far exceeds the growth rate of liquidity, a rapidly expanding economy is siphoning liquidity away from the financial assets and placing downward pressure on the stock market. Nearly all past bear markets have occurred when the economic growth outstripped the liquidity growth. So, whenever the economic growth is outstripping the liquidity growth, in that case, there is a very downward pressure on the stock market. The mode box basically shows that bullish conditions are best indicated when the indicator rises above the top bracket, while bearish conditions occur when the indicator falls below the lower bracket. The contribution to the Fab5 monetary component is -1 below the lower bracket, 0 between the brackets, and +1 in the above bracket. You can look at the mode box over here. I know this chapter is very lengthy and it has a lot of rankings which you have to keep in mind, but if you watch this video twice and if you read the book by yourself and if you make notes and just remember the ranks, then I think you'll be good to go. Figure uses a variation on a deviation from trend calculation to create an interest rate indicator for the stock market using the benchmark 10-year treasury notes yield. Instead of being represented by a longer term moving average, the trend is defined by a 70-week moving simple linear regression of the yield against time. The regression line represents the interest rate trend and difference between the prediction and the actual results. Okay. Okay, let's continue. To determine whether a given differential should be considered high or low, we plot moving standard deviation brackets around a 3-year moving average of differential. By doing this, roughly a third of the time historically spent above the bracket, indicating rising interest rates. One third of the time is spent below the lower bracket, which means it is falling interest rate, and a third of time it is spent between the brackets, which means that it is neutral rates. The 3-year time frame gives us a longer term perspective, and in that case, even the volatility is better. The Okay, you have the mode box here. The mode box basically summarizes the results from 1969 to 2014. It shows that S&P 500 has had subpar returns on average when the differential has been above the upper bracket, while it has posted strong annualized gains when the differential has been below the lower bracket. Neutral readings have been associated with average returns. Only the latest 10 years of data are plotted for better visibility. The concept behind the chart is that the rolling regression trend line could reflect a simplistic estimate of where investors might think interest rates should be in. Incorporates the tendency to extrapolate an uptrend or downtrend in rates into the future, which a simple moving average doesn't do. This indicator thus gives the different perspective on where current bond yields are relative to their recent trend. This is a useful timing indicator for the stock market. The contribution to Fab5 monetary component is -1 above the upper bracket, 0 between the bracket, and +1 in the lower bracket. Early in my tenure at NDR, Ned mentioned the classic definition of inflation: too much money chasing too few goods, with the possible exception of interest rates. Inflation is his favorite macro indicator. Its effect on stocks has been featured in his hotline many times. In the indicator shown in 32.24, we use the rate of change of the Reuters Continuous Commodity Index as a proxy for inflation. 32.24. This is the 32.24. Okay. High inflationary pressures. So whenever the inflation is high, then it is giving you a bearish signal. Whenever the inflation is less, it gives you a bullish signal. And you are taking the CCI into account. Rising commodity prices indicate inflationary pressures. When the year to year change in the 3-week moving average of future CCI is above 8.2%, it has negative effect on the stock market. When the year to year change drops by 4% or more, then the market surges ahead. The contribution to the Fab5 monetary component is +1 below 96, 0 between 96 and 108, and whenever it is above 108.2, you give it a -1. In figure 32.25, so here we have S&P 500 versus the Amex security broker or dealer. We have Amex Securities and Broker or Dealer Index, which tracks interest rate sensitive financial stocks. The operative phrase is interest rate sensitive. These stocks do well when interest rates are falling and poorly when they are rising. They also tend to lead the markets. If there are systemic risks, financials generally will ferret them out. This is why financials nearly always turn down on a relative basis before the overall stock market goes into a bear market. By smoothing the index over 10 days and employing moving standard deviation brackets, we can get a preview of where the market thinks interest rate risk is headed. The standard deviation is done over 200 days, and brackets are just under plus or minus of one standard deviation. During and just after the Great Recession, we were looking for new monetary indicators that had weathered the storm. Ned thought this might work, and indeed it did and continues to do so. The contribution to the monetary component is plus 1 when the smoothed price is above the upper standard deviation, 0 between the deviations, and minus 1 below the lower deviation. As we know, liquidity or lack of liquidity helps to move the markets. One way to tell whether Fed's monetary policy is easy or tight is to follow the trend of free reserves called net borrowed reserves when negative. Most banks must keep a certain percentage of their deposits with the Federal Reserve. Since the banks can use excess reserves, so excess reserves is basically the total reserves less the required reserves to make investments. A free reserve portion, which is excess reserves less the borrowed reserves, usually indicates easy money. On the other hand, when money is tight, banks must often borrow to meet the Fed's reserves requirement. The figure we take Fed Reserve Board data and normalize it by calculating the spread between 3-week average and 52-week moving average. This shows us any deviation from the longer term trend. When the 3-week rises faster than 52-week, the chart indicates Fed ease is accelerating. When the opposite occurs, this suggests that the Fed is becoming increasingly restrictive. While the uh, trend of free reserves is important, so is the level. As a rule, the market is in a good shape when the normalized level of free reserves exceeds 200 million.